Hello, Dividend King subscribers. This is Chuck Carnevale, co-founder of FastGraph's Fundamentals Analyzer software tool and one of the founding partners here of Dividend Kings. And what I'm doing, I'm working on a series of articles that I'll be covering over the next period of time, where I'm going to look at and discuss the principles of valuation, to try to bring the concepts of valuation more clearly into focus for you. And I do want to make a point. What I'm talking about here and what I'm going to be doing here, in the written portion, I did use numbers. I'm going to be talking about some numbers here in this video, but I really want you to get the notions that I'm trying to convey here are more conceptual. I don't want to get too hung up in the math because I want to apply the common sense nature of what valuation is. Valuation is real simple. Future value is going to be a function of how much future cash flow that the business generates on your behalf. And you can use the word money, earnings, cash flow, EBITDA. It doesn't matter. It's how successful the business is. And present value is going to be a multiple of current earnings, cash flows, etc., that position you to be able to participate in the growth of the business over time effectively. Because as I mentioned in the written portion, any investment that generates a what I'll call an annual income stream is worth a multiple of that income stream because it pays it year after year after year after year. And now that multiple can be very similar for companies with what I would call in the average range of growth, where there's very little difference. But thanks to the power of compounding, that can change very dramatically at higher growth rates. But it's really got to be higher growth rates, above 15%, before you really get a different present value multiple that makes any sense. So otherwise, companies will have a present value multiple that's very similar, but that is not what drives your future return. What's going to end up driving your future return is the growth rate of those income streams that the company's generating, because the faster they grow, the bigger they're going to be in the long run. I'm going to kind of cover that here in this short video. I'm going to start with what I'll call a lower growth or an average growth company, Kellogg's, and I'm going to use this as the equivalent of a 5% grower. And my point is that this company, the orange line in this graph, is a 15 PE, and the blue line is just under an 18 PE. And the point is, this is a fair value or a present value for this stock. So it's a measurement of soundness, not rate of return. The rate of return is going to be a function of how fast that earnings line grew in this example. And I'm using operating earnings here. So the point I want to make is when you buy a stock near its fair value, its fair present value, then you position yourself to participate in the growth. Always going to be volatility in between. That's why I say don't focus on the stock price. Don't follow the stock price because it's crazy. You can see how, in this case, how volatile this stock price has really been and how much it's deviated from its quote-unquote fair value, which it was perfectly aligned here and then perfectly aligned again here, notwithstanding some cyclicality in the middle. But the point is, a 4.81% growth rate is going to generate a rate of return that's consistent with that growth rate. In this case, it comes out to 3.7%, but that's only because the valuation was high, a PE of 20 here at the beginning, and lower at a PE of 16-ish at the end. So, a 5% grower ended up giving you capital appreciation of about 4%, 3.7%. Now, if I move up the food chain, if you will, and look at a faster growing company, and this is really a quintessential example, I want you to notice a couple of things. First of all, the slope of this line is obviously twice as steep. Therefore, you started out with this little bit of earnings here, and you end up with this much larger amount of earnings here, mountain chart of earnings here at the end. So the key is this company grew at roughly 10%, 9.93 to be precise, and it was just about at fair value in the beginning, a PE of 14.9, and just a tad higher than that here at the end. So you're going to see a rate of return, a capital gain, a capital appreciation return of probably just over 10% here, but it's consistent with the growth of the business, and it actually came out 10.3%. And my point is that you still have that same 15-ish fair value, present fair value in this example, even though the company's earnings grew twice as fast. So I want you to make sure you recognize there's a difference between the present value anything that produces an income stream is worth a multiple of that annual income stream, whether it grows or not. That's going to position you to participate in the growth of the business, but the growth of the business is what's going to generate your rate of return. Now let's move up the food chain again and look at a company like United Healthcare that's doubled the earnings growth rate almost again. Here we got just over 19% growth, or just under, double the 10%, if you will, which was double the 5%. And once again, you've got reasonable alignment of valuation here, a PE of about 16.6 and ended up about 17.38. So your 19% growth rate is going to give you capital gain slightly higher of 20.1%. But again, you can see that by looking at the company, at the growth rate in the chart here, looking at where the chart is in alignment with its earnings. The point is, here we have a real tiny little bit of earnings in the beginning that ended up in this much, much larger level of earnings at the end. It's the cash flows that drive the rate of return, the future cash flows. But you've got to have the fair value, the intrinsic value at the beginning, so that you participate in this growth, or you align yourself to participate fairly within that growth. Okay, and then the next, I'm going to move the cash flows with my next example, which is even higher growth yet. Now I'm looking at Amazon. Now I'm using cash flow here because Amazon purposely doesn't try to make profits. All these things, earnings, cash flows, GAAP earnings, adjusted operating earnings, EBITDA, these are all measurements of the company's success. It really ultimately comes down, their bottom line moving metrics, but it really comes down to top line. How fast is the business growing? This is a very fast growing business, averaged over 31% growth. Now here, I've changed the time frame only back to 2005, and I did it so that my graph looked pretty. I don't mind telling you that because I want you to get the essence. I've got a 30% grower here, and when I look at performance, I end up with just about 30% capital appreciation annualized, 28.2%. And again, it is only a slight valuation difference. But look here, look how tiny my cash flows were in the beginning and how big they are here at the end. It's this mountain chart of cash flow, mountain chart of money that gives value to a business. And you need to think that way, in my opinion. Don't worry about whether the price is up or down, because you can see even here you've got all kinds of volatility. The real question is whether or not you're positioning yourself to participate in the company's growth at a prudent valuation in the beginning. And let me end up with one final example, a stock that we all know and I've covered many times before, which I think will crystallize this. With my last example, I'm going to look at Johnson & Johnson, because what this does allows me to crystallize the valuation references here by taking advantage of the dynamic calculator function of fast graphs. What you see here is about a 9% grower. This would be very similar to the General Dynamics number that we saw earlier. The point is, there was a time back here where the valuations were very high. Johnson & Johnson was out of alignment. Now, had you bought the stock when it was trading at a 32 PE here in the beginning, the company grew by 9%, but your capital gain was roughly half that, or not quite, but only 5%. So the point is, this has the same 15 PE or 15 present value, intrinsic value, if you will, as we saw with General Dynamics. And so valuation had a significant impact on the rate of return you owned. So that's why it's so important to get valuation, in alignment. In contrast, using this same example, if I bought it at its peak valuation here when the PE was 32, and even though it went back to fair value here in 2013, I bought it in 2002, we'll call this 11 years, you end up only making 3.5%. But yet if you just run your eyes across these numbers here, this company was generating double-digit growth literally for the vast majority of that time frame. So the company did really well. The orange line grew. And by the way, if I go ahead and add dividends, the dividends for this company grew each and every year here as well. And, threw off a lot of dividend income, which I'm getting into a full fast graph now. But the point is, you made a what I'd call subpar return from an above par company with above average growth because you overpaid for it. In contrast, then, if I switch that around a little bit and I buy this company, even before just before as we entered, I'll call it the Great Recession, and I bought it at a valuation that was roughly that 15 PE and held it to where it's roughly the similar PE now, I end up making over 8% a year holding the same company, which grew about the same rate over both these time frames, not exactly, but the point is valuation matters a lot, but current value is a function of a rational multiple of earnings or cash flow that allows you to participate in positions you to participate in the company's growth. And future value is going to be functionally related to how fast the company grows. But if you overpay for the company, you end up taking higher risk and then settling for a much lower rate of return, and you're not really getting what I would call the full benefit of what the company can give you. So valuation is critically important. But I wanted you to understand the essence of valuation. Valuation is really functionally related to the cash flows that the business generates. I'm calling that earnings in this example. This is what gives value. It's going to give you your future value, but it's also going to allow you to participate in this future value if you buy the company at value in the first place. Anyway, this has been Chuck Carnival saying I hope you enjoyed this. If you like the video series, don't forget to subscribe to my Fast Graphs YouTube channel and give me a like for the video, by the way. That would be helpful also. And of course, most of all, thanks for being a Dividend King subscriber. Our goal here is to help you make more prudent, sound, and ultimately more profitable long-term investment decisions. Thanks for watching.